So we'll start. So first, let's start from the question. Like, what is the question? Thereafter, we'll read the problem. So prepare an operating statement for the month ended 30th June 2007 under absorption costing. So that is what we are going to do. So here are the answer hints are there. So we can also compare our answer. So the question says that Sydney manufactures one product and the entire product is sold as soon as it is produced. There are no opening or closing inventories and work in progress is negligible. The company operates a standard costing system and analysis of variance is made every month. The standard cost card for the product, a boomerang, is as follows. Okay, so the company is producing a product called as boomerang. This is a standard cost, okay, standard cost sheet. So direct material half a kilo at $4 per kilo. Direct wages 2 hours at 2 rupees. Variable overhead is 2 hours at 0.3. Fixed overhead is 2 hours at 3.7. So standard cost is 14 and standard profit is 6. Standard selling price is 20. So the company budgeted planned output for the month of June 2007 is 5,100 units. Actual results for 2007 were as follows. Production of 4,850 units was sold for 95,600. So see, all the units have been sold, so there is no closing stock or anything here. So this data also helps us to give us what is the selling price, average selling price you can find out. Material consumed amounted to 2,300 kgs at a cost of 9,800. Again, you can find out actual price per kg. You can find out through both this information. Labor hours paid for amounted to 8,500 hours at a cost of 16,800. So this is what they have paid. But if you see, the actual operating hours is only 8,000 hours. Okay, so there's a difference of 500 hours between what is paid and what is operated. So the difference is actually idle time. Idle time is also a variance, and idle time is usually a negative variance. So they also say that variable overhead is 2,600 and actual fixed overhead is 42,300. Okay, so you have all the numbers here. Your job is to just create numbers for this. Okay, so we can start. So first one is sales variance. We'll start. So we have to get what is the standard quantity of material they thought of selling. So they thought of selling 4,850 units, and actually how much they have sold. Okay, sorry, they thought of producing and selling 5,100 units. 5,100 units they thought of producing and selling, and actually how much they sold was 4,850 units. Okay, standard prices. What is the price per unit? So it is 20 here. So it is 20. This number is dollars per unit. What is the actual price they thought they sold for? So actual price they sold for is not given. Okay, it's not given. We only have to compute it. So let's compute that. So it will be 95,600 divided by 4,850. So if we do this, we will get the actual price per unit. So it is 19.71. We also have to find out what is the standard margin, okay, or standard profit per unit, that we have to find out. So better we'll take this number here and we'll try to find it out. So standard profit per unit is readily given. It is $6. So as we are doing for absorption, we have to just get that profit number. So let's get the formula ruling. So price is AQ $4,850 into SP minus AP. AP is Again SM is 6, SQ is 5100 minus 4850. Okay, see, both numbers are positive, but look at the logic. They should have sold 5100, they have sold for 4850 only, they have sold. So is it a favorable or adverse? It is adverse. So this is also will be adverse. They should have sold a unit at 20 rupees, they sold at a discount of at a discounted price of 19.71. So both are adverse only, right? So done. So we'll move on to material variance. So material variance, we need to get SQ, AQ, SP, AP. Standard quantity is, see, it takes half a kg to produce one product into how many actual units they have produced. They have produced 4850. So solve this and you will get the kgs. Okay. So what is the actual quantity of materials bought? So it is 2300 kg. So you have it here. What is the SP? Standard price is per kg. It is $4 per kg. It is $4 per kg. What is the actual price per unit? That we have to find out. It's not directly given. So how do we find it out? So 9800 amount is spent and 2300 kgs have been bought. So what would be the price? $4.26. So AQ is 2300, SP is 4 minus 4.26 SP is 4 into SQ is 2425 minus AQ is 2300, SQ minus AQ. So I think we'll get the answer here. So you can see here, they should have bought it at 4. They have bought at 4.26. So it is adverse. And they should have consumed 2425. They consumed only 2300. So that is favorable. So that's about the material variance. So we'll see the other variances here. So the next variance is labor variance. So labor variance is standard hours, okay, actual hours, standard rate, and actual rate we have to get. Let's get the standard hours. See, it takes 2 hours to produce a product, right? And how many products the company produced? It produced 48850 units. Okay, what is the actual hours? Actual hours, I think he has told it here. So there are 2 actual hours. That is going to confuse us. See, the first one is there is going to be like 2 hours here. One is actual hours worked, sorry, actual hours paid, and there's also going to be one more number which is called as actual hours worked. Okay, and there's also going to be one more variance which is called as idle time idle time variance. So this variance would be standard rate into actual hour paid minus actual hour worked. Okay, so this difference is going to be this ratio. It will always be adverse only. Idle time is always adverse. So we'll get here. So the actual hours paid, okay, we have to pay for 8,000 hours, for 8,500 hours, because that's what he also says. See, actual hours paid is 8,500, and we have to get actual hours worked. They have worked only 8,000 hours. Okay, done. So this is also, both are representing hours only. So done. So what is a standard rate? Standard rate is every hour we pay 2 per hour. Actual rate is, it's not directly given, we have to compute it. It is 16,800 divided by 8,500. So it is 16,800 divided by 8,500. So this is what we are paying them. Okay, so we got the number here. Let's work out the formulas and let's get the answer. Okay, we don't have enough space. Okay, we'll start. So actual hours, I think we'll amend the formula also, or else we can't get the formula perfectly. So we'll amend the formula. See, rate is what we paid. Okay, what we paid is the concept here. Okay, so actual hours paid, that is the main aim concept here. But here it is the actual hours worked. Okay, it's actual hours worked only is the main concept. So these are new formulas, so ensure that you remember this also. Now we'll work out the formulas. So actual hours paid is 8,500 hours into standard rate to actual rate 1.97647. Okay, I will take the entire number, or else there will be some rounding mistakes will occur. So we'll close the bracket. Done. So next one is standard rate into standard hours into actual hours worked, that is 8,000. Next one is standard rate, idle time is standard rate into the difference. Okay, the difference between hours paid. For 8,500 hours we paid, but employees are not working for, are working only for 8,000 hours. So all of this we will get the answer. So let's look at the answer here. Let's look at the answer here. We should have paid 2, but we have paid 1.97. See, that is a good thing. So it's favorable. They should have worked for 9,700 hours, but they have worked, we have ensured that they are working for a lower number of hours. So that is, it is efficiency. It is a good one. Okay. So the work will take 9,700 hours, but we have completed it 8,000 hours itself. So that is a good thing. The last one, idle time is always a negative variance. Okay. Why? Because they are sitting idly. Why should we pay for it? So that is the concept here. So we got up to that point. So let's work out the other variances. So the other variances are variable overhead variance. So we'll compute from here. So standard hours, how many hours they have to work? See, variable overhead hours, okay, works along with the labor hours only. Only when the labor hours work, okay, so we'll put it like this. Note, I think we'll put a note here. Note, variable hours are incurred only when labor when labors are working, okay, it moves along actual labor hours. Okay, so hope you got the idea here. So okay, so that is a very important point. Okay, if you want, I'll mark it in another color, so just remember that. So we'll start. So standard hours, how many hours should they work? See, standardly they have to work for 2 hours per unit. And how many units are produced? 4850. So they should have worked for 9700 hours. See, here variable overhead amount is given, but the hours is not given. So what we'll do is, we will take it as the actual hours when the machine, see, these are machines which are working along with the labor. So labor itself, if they are working only for 8000 hours, the machine will also be used only for 8000 hours, right? So what's the standard rate? Standard rate, I think they have given it here. Okay, it is 30 paise per 30 cents per hour. What's the actual rate? Actual rate we have to find out. So totally they are incurring 2600 divided by, so what rate should we use? Should we use 8500 or should we use 8000? Okay, which one we have to take into account? So we'll work out now. See, so 2600 has to be divided by 8000, because 8000 is the actual hours they are working. So like that only we have to find. So the rate is going to be 3.025. Okay, so we'll next work out the expenditure ratio. So expenditure is 8000 into 0.3 minus 0.325. Let's see the answer. The answer is minus 200. Okay, the answer comes to minus 200. So we'll work out the efficiency ratio. So efficiency ratio is standard rate, which is 0.3 into standard hour is 9700 minus 8000. Okay, so this is favorable, but this is adverse. This is adverse. So that's with our variable overhead ratio. So next we'll move on to fixed overhead variance. So in fixed overhead variance, we will work out first these numbers. Okay, so to find out that, we have to get our budgeted, actual, recovered and standard. So first let's get the budgeted. So the budgeted units, okay, how many units they thought of selling is 5100, and the standard rate for fixed cost per unit is 7.4. okay, so 7.4 is the standard rate per unit, and they thought of selling 5100 units. So we'll take this number, we'll put it here. So we got a number. So the second number is actual units. So if there's directly, if they have given actual overhead, fixed overhead, it's great. So they have given, it comes to 42,300. So we'll just type it directly. So the next one is recovered is recovered. So recovered has a formula like this. You have to get the budgeted fixed overhead, which is 37,740, divided by budgeted units. So budgeted units is the number of units we thought of selling, into actual units. So actual units is 4,850. So again we get a cost. So the next one is budgeted overhead divided by budget hours into actual hours. So we'll just copy this. So budgeted overhead is correct. We got that number. What is the budgeted hours? Okay, hours it takes to produce this. So the actual hours worked is what we should take. So let's check. Each unit should take 2 hours. Okay, so that is like clear. 2 hours. So this answer should be multiplied by actual hours. So there are 2 actual hours. One is the actual hours paid and the actual hours worked. So we'll take the actual hours worked and we'll try to find out the answer. So we'll insert all these numbers here and we'll get the answer. So the first one is recovered minus actual. So recovered is 35,890 minus actual is 42,300. The next one is budgeted. So budgeted is 37,740 minus actual is 42,300. Next one is recovered minus budgeted. So that is 37,740. Next one is standard 29,600 minus budgeted, which is 37,740. Last one is recovered 35,890 minus standard, which is 29,600. So we have done. So we can just copy it and get the answer. Okay. So wherever there is a minus, we'll put adverse. And there is only one favorable. Right. So we have done with all the variants here.